So a quick welcome to those who are joining us on the replay. And at this time, I'm going to turn over the webinar to our host, Paul Wright.
Thank you, Maria. Welcome, everyone. I'm Paul Wright, co-founder of Wright Venture Services, and we help entrepreneurs access new customers, gain access to capital, and we help consult agencies that support entrepreneurs. Now, I have over 20 years experience in community impact investing and entrepreneurship, and that includes 3 businesses, 2 social enterprises, and both in the financial and professional service sectors. And I'm really delighted to be able to share some of my experience and have my guest speaker on today with you. And I'll introduce him now. Alan Groscheider. Alan is an entrepreneur based in Louisville. He started his first business in 1993, and he's built several companies from the ground up, raising capital in just about any way you can imagine, including loans, credit cards, friends and family, private placements, crowdfunding, and venture capital. His largest venture to date raised significant VC funds. He became a nationwide environmental inspection company with operations in all 50 states and eventually sold this to a larger firm. Currently, Alan is building a company called Blue 222, which is Uberizing the business of real estate inspections on a global scale. He also runs a nonprofit organization called Metro Startup, which is working to make it much easier for startups in the Louisville area to raise capital with equity crowdfunding and access several very large equity funds. Alan, you want to say hello?
Hey, everybody.
All right. And I want to point out, Alan and I are we're founders of a new network with direct links to a venture fund. The Sheltowee Business Network is a high-touch community of entrepreneurs and advisors and capital providers dedicated to enhancing one another's business. We emphasize a highly effective in-person interaction and provide relationship management tools. We're dedicated to growing businesses, starting new companies, and cultivating entrepreneurial leaders. So you'll hear more at the end of our talk today about Sheltowee Business Network. Okay, so we're recording. Thank you, Maria, for giving us some instructions. Let's get started on avoiding the sharks, how to get capital for your startup through equity crowdfunding. Now, what we'll cover today, our main purpose today is to just introduce you to equity crowdfunding and hear from someone like Alan who's got that experience raising capital. And we'll first review a framework of venture capital and fundraising. We'll go through the different types of equity investors, just setting a framework of what are the different stages of growth where you want to access capital, and it's just an overview of crowdfunding as a platform. And then I'll turn it over to Alan. He's going to share his story and how he raised funds and the tips and lessons that he has learned. And then you'll get a chance to type in your questions, and we'll have a Q&A sessions by the end of the hour. So let's get started. Stay on the webinar today, because by the end of the day, you should know what investors expect from you, and you might be able to be more prepared to give a good pitch, understand different fundraising platforms and pathways, and be more informed about rules and regulations. Now, I'd like to find out a little bit who's on the call, so I'm going to launch a quick little poll here. Let's do this. So, which of these best describes you today? You're an entrepreneur seeking funds to launch your new business. You're an economic developer supporting the entrepreneurship community. You're an investor in small businesses or entrepreneurship programs in your community. Or you're a learner that doesn't really fit in any of the other categories. So let's give a few more seconds here, and I'm going to end the poll in a few seconds. Thank you for everybody's participation. Okay. So I'm going to share results. Looks like we've got the majority, well, it's a split between entrepreneurs and learners. And, we're all learners here today. So thank you for being a part of this. And let's move on. So let's look at the investor's perspective. Investors, let's start and talk about some of the basic definitions and frameworks and compare and contrast what investors expect. Similar to the financial markets, investors will often take a diversification approach. They invest in different asset classes from, bonds to equities to real estate. And oftentimes they come in different types. Institutional investors who manage funds all the way down to your neighbor next door, which you might not realize that has, money to invest. They oftentimes, those who invest in startup companies like to invest at certain stages of growth or in certain industries or sectors that they're more familiar with. But they are, like any investor, are concerned about risk and what type of return they're going to get. So that's kind of starting out some of the perspectives there. I've got this quote here from Steve Case, former CEO of America Online, and his perspective is the idea of an entrepreneur is really thinking out of the box and taking some risk and stepping up to the major challenges. What do you think Steve's saying here? What are his expectations? You know, the way I read this is that he's expecting exceptional, innovative thinking, and most importantly, someone who's going to overcome the odds. Now, this isn't an exhaustive list, but this is what some of the investors consider. They look at the founder, and they also look at their experience and their team's experience. They're most interested in finding out what kind of problem are you solving, and is that a valid problem, especially a problem that your solution that people are willing to pay for the solution that you're offering. They're oftentimes looking for intellectual property where they can have patents and trademarks, scalability, and usually they're looking at certain tech or bioscience or tech type of industries where there'll be growth opportunities. And then finally, they're looking for financial returns. Now, there's different type of equity investors. You got the investment bankers doing mergers and acquisitions, usually on Wall Street deals, everything to the VC funds, typically between $500,000 to $5 million range. These are oftentimes larger projects. And then you have your angel investors and syndicates. These are the startup, pre-revenue. This is the most sought after money. Typically the range is between $50,000 to $500,000, $50,000 to $500,000. And then you have just your one-on-one individual angel investors. They're not necessarily working in a group. They typically invest at the concept or startup stage, and they're often okay with the pre-revenue level of the business. And they're somewhere between the $5,000 to $50,000. Usually the average is about a $20,000, $25,000 investment from an individual investor. And then you have your friends, family, and fools. This is where most entrepreneurs start out at the concept stage. They usually are getting somewhere between $1,000 to $25,000. And then all of us know you usually invest yourself. And in fact, most of the folks that are going to invest with you want to know that you have invested. And the sources can be home equity, retirement, credit cards, unfortunately. So these are some of the different types of places where you might find some equity investment. Let's look real quick. What capital do you need to raise, and when do you need to raise it? This is a little chart I got from the BC Renaissance Capital Fund. I think it's a really good way of explaining just kind of what we talked about. The different company, your stage of development. Are you in the idea stage, startup, development, growth, maturity? Down at the bottom here, it's the investment stage. Are you at the seed level where you're pre-revenue in those yellow and pink areas? Are you at the area where the angel investors come in? And that's typically before you've rolled out your product. The green line here is kind of what they call the hockey stick, where it goes down and then comes back up in terms of your cash flow and growth. And then the black line is usually the timeline. And this little trough down here is called the Valley of Death. I know that Alan mentions that in his talk, but what you want to be sure is that you're able to launch out of that Valley of Death as you roll out, begin to generate revenue, and you're going to be more attractive, of course, to those early stage VC venture capital firms and later stage venture capital firms when you start to hit your expansion and growth and get greater market share. So this is a good framework for you to understand, what is the different stage? When do I need to raise capital? What I've noticed is oftentimes there is a mismatch between where you're at and the type of access to different investors that you have available to you. So some of the challenges, let's just talk about this for a minute. Access, who you know and where you live. Now, this is a hard one because there are sometimes your network might not be as large as someone else that you know. But it's oftentimes people that you might have gone to school with or that you've met in other places that actually are potential investors, and you might have written them off or don't even know that. Now, one of the other things is where you live, and your proximity is important. Unless you live near the West Coast or East Coast, you're less likely to know venture investors. Investors often cluster around high-tech communities with talent density, just like Silicon Valley. But the rest of the U.S. is often called the flyover country, Midwest, the South, and this is kind of inefficient. And these inefficiencies of matching up investors with startup entrepreneurs is being solved by crowdfunding, which is our topic here I'm about to turn over and talk about. Groups like the Shelter We Business Network are bridging the gap and helping address some of these issues. Now, the final thing I want to talk about the sharks. The title here, sharks aren't always bad. I guess they are if you're out swimming in the ocean and there's blood in the water. But Shark Tank, as you know, a TV show, has made Americans more aware of venture capital. But, while these TV stars are often kind of sensational and perhaps, atypical in the process of raising capital, what is clear is a conflict between what the entrepreneur sees and values and what the shark investor sees and values. And that gets played out on this TV show. Oftentimes, some of these disconnects are the entrepreneurs seeking capital, mentors and access to distribution, but they're trying not to give up too much control or equity in their startup. While the investor sharks have experience in their industry and they know their perceived valuations are different, and they often want more equity and control of that startup. So, you may also you have to realize you're being perceived as a good bet. And we see that playing out on that TV show. So some of these are challenges, but they can be overcome. Now let's just look at a real quick overview. What is crowdfunding? I consider it like a democratization of fundraising. It's making fundraising more accessible today. And many of you on this call probably have accessed or gone onto a platform. So let's just look at a few of those and just briefly. First of all, there's the donation-based crowdfunding. This is more of a personal charitable causes. It's not typically for businesses. They aren't really using this platform. There's no expectations to repay. Sponsors get to keep what they raise. Today there's over 600 different crowdfunding platforms, including these donation ones, and it sure makes it a lot easier. And I want to point out that since the Jobs Act in 2012 and some of the new SEC rules that you'll hear more about, crowdfunding platforms have really grown exceptionally and exponentially. And the World Bank actually predicts that crowdfunding will grow to a $300 billion industry by the year 2025. So it's here to stay. Rewards-based crowdfunding is another platform. Investors give cash in exchange for a reward. Now, I've seen this and participated in programs like this, and it's oftentimes an advantage to the entrepreneur who's really pre-selling their product or service. Or they're giving some type of special recognition or reward back to their investors. It's a great way to test and validate your market. And the best example I like to point to is the Kickstarter campaigns that are out there. And those are ones that I've participated in myself. Now, debt-based crowdfunding, typically it's a microloan. Oftentimes, like Kiva's less than $25,000. It can, be product-based or cause-related. So they do use the power of social capital and social networking to be able to spread the word about their product or service. It's an all or nothing capital raise, so you kind of know you need to set the right raise amount. So if you don't make that amount, then your investors aren't obligated to fulfill their investment with you. And the example there is Kiva, which has had an impact, especially in kind of the social enterprise sectors as well. And finally, we get to the equity-based crowdfunding. This is kind of the new one on the block. When investors give you money, you give them a piece of your company in exchange. And typically, this is available to accredited investors. But there are platforms like microventures that allow you to be unaccredited investors as well. And I think Alan's going to speak and give some definitions in his presentation here in a moment. But as it relates to crowdfunding, I want to leave you with this one quote by a co-founder of Google: always deliver more than expected. And that is that's from Larry Page. So I am going to finish my part and stop sharing my screen. And if you have questions, if you want to type those in to the Q&A box, we'll get to them during our question and answer period. Okay. I'm going to mute, and if you want to unmute.
There we go. Can you hear me?
Yes, we can hear you.
Okay. Well, thanks, Paul, for the introduction. And you covered actually a few things that probably make my presentation more understandable, because I typically don't get into the types of investors and too much into the different types of ways of raising capital other than crowdfunding. But one of the reasons I started MetroStart, it's a nonprofit whose intent is to help startups raise capital locally in our region and accelerate the use of crowdfunding, because there's a lot of reasons I think that will help spread the risk and accelerate startups all over our region. But I've raised capital several times, as Paul mentioned, and the hardest, it gets harder and harder to raise the early capital. Paul showed a couple types of angel investors and showed on there that they could invest at a pre-revenue stage in the company. And what I found is that is becoming less and less. There are less and less people who are actually willing to invest in an idea or a pre-revenue stage, which makes it impossible for companies to get started. Unless you have a rich uncle that's going to write you a check to get your company started, most of the time it's just, you just die, you just never actually get your idea off the ground. So what I'm going to talk about today is a nice way to raise capital at that early stage, and something that I want to see happen a lot more. One of the reasons why why this has not really taken off yet, because the experienced old school angel investors in our area typically tell you that you can't start a company with a bunch of small investors. Usually their excuse is, well, any one of those investors can sue you, which is true. And they also say no VC firm is ever going to invest in you if you have a bunch of small investors. And I think both of those things are BS reasons for avoiding crowdfunding. And I'll give you a couple of examples of companies that have done this very successfully. One of them is when I was in college, I would come home in the summer times and I would work out at a gym in Southern Indiana. And I would see this guy literally walking around the gym asking people to invest in his company. Every time I saw him in there, he was asking people to invest in his company. And I talked to another guy that knew him one time, and he said, this guy is a nut. He walks around the gym asking people to invest in his company. And he says he's going to build this big national company that's going to take on Pizza Hut and Domino's. And, so you can guess who that was. So a lot of people haven't heard that part of the story. People have heard Papa John talk about his selling his Camaro and building an oven in his dad's bar, whatever. That whole story is the one everybody hears about. But what they don't hear is he went out and raised capital from a bunch of smaller investors, $5,000 to $10,000 investors. And those investors, I'm sure, ended up doing pretty well. So, that's really crowdfunding. So that's a great example that small investors can definitely lead to big success. A second example is my own company. I started a company in 1994 called ESA1. And our goal with that company was to build a nationwide environmental inspection company with a lot of our, just using newer technology at the time to make it very efficient and to be really efficient across the country at doing these type of environmental inspection. So I started a company with 4 investors who each put in $6,000, and then I put $85,000 on credit cards, which I do not recommend. That I wouldn't do that again. So, but it ended up working out okay, because then I went on and raised $350,000 from 52 individual investors, and then $3 million from a VC firm. So there's another example that a venture capital firm, as long as you set it up correctly on the front end, a VC firm is willing to invest in a company that has multiple small investors. And it allowed us to get started and get the company to a point where we could raise larger capital. And that company went on to operate we had employees in 30 different cities, and we operated in all 50 states and ended up selling to a company in North Carolina. So another example, small investors can lead to big success, and they can help you get started when you don't have money from the rich uncle or somebody that's going to write that first check to you. So the point of this presentation is, well, how do you do that? The classic way that people raise capital, and this is the way, one of my complaints about the startup community in our entire region is that people seem to recommend that you go find a rich person. That's how you raise capital. You go find a rich person who knows what they're doing. And so you start with your idea and your corporation, your business plan. You get your friends and family, hopefully, to invest a little bit that kind of gets the ball rolling. And then you find that the lead investor, who is the rich person who knows what they're doing, and they help you put together all of the complicated stuff that gets your company started, so that you can go out and raise capital. And then the lead investor goes out and gets friends of theirs to invest, and you raise your capital and get started. Now that works, but the problem is it can fall apart at any time. And it's also a very small sliver there are a very small sliver of startups out there that actually do this. So if there is I always use Bruce Lunsford as an example because I hear about projects that he's involved in. And normally if he's going to invest in a company, he kind of follows this process and is able to get a lot of people involved. If you can do that, that's great. But the vast majority of startups just crash at the friends and family stage or the find lead investor stage, and they never make it. They just quit before they even start. Excuse me. So a better way that I've found is you start with the same idea, incorporation, and business plan. Then you prepare what's called a SAFE agreement. And I'll explain more about that. Then you file with the SEC so that you can legally raise capital. Then you go out and network like crazy, and you find a lot of small investors. So I mentioned a SAFE agreement, and you also need to have a business plan. So to me, the SAFE agreement is something that the investor signs that explains what they're getting for investing in your company. And it explains the relationship between the investor and the company and the protections for the company and the investor. And then your business plan is nothing more at this point. I mean, it should be a business plan that makes sense to you and you're going to try to follow. But at a really early stage in a company, your business plan is just kind of a dream, and it needs to be a sales tool that gets investors to invest in your company. That's the primary thing. It needs to be something that's exciting. It has a lot of sizzle to it, makes sense from a financial standpoint and marketing standpoint, and all the different things you need to include in a business plan. But the primary reason you have a business plan at this point is to get people to invest in your company. What's a SAFE agreement? A SAFE agreement was created by Y Combinator, which, if you don't know, is probably the largest startup accelerator in the country, or the most successful. Airbnb was a Y Combinator company. And Y Combinator wanted to figure out an easier way for startups to get started. And that's what Silicon Valley primarily uses right now at the early stage of a startup, is a SAFE agreement. It works like this. If somebody, let's say you need to raise $100,000 to get your company started. So you create a SAFE agreement, and then you go out and you get 10 people, for example, to write checks for $10,000 into your company, and they sign a SAFE agreement when they hand you a check. Well, at a later, you take that $100,000 and you go out and you prove that your idea is a good idea. Now you are attractive. Maybe you have a little bit of revenue. You've got a website that has some function to it, and people can see that there is something to your idea. And now an investor comes along that's going to put $1 million into the company. So now those investors that gave you a check for $10,000, they get to piggyback on the terms and conditions that are negotiated by the larger investor. So they don't have to, at the front end, you don't have to worry about the cap table. And depending on how new you are to this business, some of the stuff you may know, but a cap table explains who owns the company, and the valuation is how much the company's worth. Shareholder agreement is the contract between the shareholder and the company. So there's a whole bunch of stuff that typically goes into raising capital. And if you use a SAFE agreement, you don't have to do any of those things because they get negotiated later, and they get negotiated by somebody who probably is more sophisticated than the other investors that you bring in early on. And so it provides a lot of protection for everybody, and it makes starting the company a lot easier. Now, what about SEC filing? This is something that lots of companies just don't do, and they have no idea they're even supposed to do. So usually if you involve a lawyer that has some idea what they're doing in the starting of your company and the creation of the way you're going to raise capital, they'll know to file with the SEC. And what it says is you're filing with the SEC to notify them that you're raising capital for your company, and you're really supposed to do that even if you're immediate family members that are investing in your company, you're actually supposed to file with the SEC and notify them that you're not a public company. So this is an exemption that allows you to legally raise capital, and then each type of exemption comes with certain rules. There are 3 different types of exemptions that get used, or that you may want to know about. They're the most likely for you to use when you're raising capital. And this, some of this sounds kind of complicated, but these are simple forms. These are forms that you fill out on the SEC website and just notify them. I don't even think there's a charge for filling out the form, and you notify the SEC that you're raising capital. And a lot of people don't do that. If you don't do that, the SEC can make you give all the money back. They can shut your company down. They can make it so you can't raise capital for a period of time. So there's a lot of big consequences if you don't fill these simple forms out. But the 3 different types that you need to know about are a Reg D 506B, a Reg D 506C, and a Regulation CF. A Reg D 506B is the old way. This is the way that startups have raised capital for since I think the 70s or 80s or something. But and so that's what's happening when the Bruce Lunsford types go out and raise capital for a company. They're filing a 506B, and they have to privately raise capital. That you cannot advertise at all. You can have an unlimited number of accredited investors, and accredited investors is basically a millionaire. You can have up to 35 non-accredited investors per year. And again, you can't advertise. And in order to prove that you didn't advertise, you have to show that you had existing relationships with those investors. So it's a little limited, but it's the way that most companies raise capital. Now, the type of raise that I like is called a Reg D 506C. This became legal. Paul mentioned the Jobs Act in 2012. A Reg D 506C became legal, and nobody's using it, especially around here. I think it's being used. It seems to be used a lot in capital raises for for big real estate investments, but most companies haven't been using this. It allows you to raise an unlimited amount of capital from accredited investors only, but you can advertise as much as you want. You can run ads on Facebook. You can run ads on LinkedIn. You can run a full page ad on the Wall Street Journal if you want to, advertising for people to buy shares in your company or invest in your company, and you can accept the money right into your bank account. You don't even have to go through a portal. So it's a great way to raise capital that I think our community needs to embrace. A Regulation CF, when I first started MetroStart, I thought this was going to be the way to go, because this became legal in 2016. This is sort of equity Kickstarter. You can raise up to $1,070,000 per year, all online through a licensed portal like MicroVentures that Paul mentioned, and WeFunder and Start Engine and Seed Invest. And there's 40 something portals. You can advertise. and you don't have to have any kind of existing relationship. You can bring in any of these investors. The problem is, what I found, I've seen a couple companies locally try to raise capital this way. When you have these small investors, $1,000 minimum investors, you have to advertise a lot in order to raise a decent amount of capital. So you might have to spend $100,000 to raise $300,000. And it's just doesn't seem to really work. The exception, I think, eventually companies in our area should use a Reg CF when they want to spread the ownership out to a lot of people in the area. I think that's something that, my company, I hope eventually will use this so we can let a bunch of our users of our system, and I'll talk about my other company in a minute, own a little piece of the company. So I think if you have a huge customer base and you want to let people invest a little bit in your company, this is the way to go. Not good for early stage startups. So this is my recommended plan. And I mentioned my company, Blue222. I started a few years ago, and it is a company that is Uberizing the business of real estate inspections, like appraisals and environmental inspections and building inspections, home inspections. So we have a system that makes it really easy for banks to manage all of their vendors that go out and do that work for loan closings. And once they're on the system, it becomes a platform that makes those people available in sort of a Airbnb or Uber way for anybody. So the way that we raise capital, I knew early on with this company that local investors really don't like to invest at the idea stage when you don't have any revenues. So we had to practice, what I'm preaching for MetroStart, and this is the way we did it. We started with the 506B. That is the private placement, but it allows you, and a safe agreement. And the 506B allows you to, again, take investments privately from people that you already know, and it allows you to accept up to 35 non-accredited investors per year. So we went after our existing friends and family and invested our own money, and raised as much capital as we could that way. And what I ended up finding was that most of the people that invested ended up being accredited investors anyway. But if you file a 506B, you can bring in investors that are non-accredited if you have some family members that want to get in. We also started a monthly email update using MailChimp, and you can use Constant Contact or whatever. But this proved to be surprisingly successful in getting investors in, because people invest when they're ready. When something, maybe they just got a tax return back or something, and they've got some money burning a hole in their pocket, and you've been sending out updates for 6 months, and they really like what you're saying is going on with your company, and you hit them at the right time, and then all of a sudden they show up and they invest. So the monthly update is sort of step 2 that I would recommend. Then once we ran out of the friends and family investors, we switched to a 506C. Again, that is the capital raise that allows you to publicly advertise as long as you only accept investments from accredited investors. So that allows us to run Facebook ads and LinkedIn ads and post things on Twitter and drive people onto our monthly email updates. And then we just kept sending out monthly updates, and investors showed up. In fact, we had one investor invested $60,000 without ever even talking to me on the phone, and just emailed and said, "Hey, how much is left in this round?" and just said, "Checks in the mail." So it really works. Now, it helps to have some marketing, a little bit of marketing knowledge when you're running those Facebook and LinkedIn ads and things like that. So you are going to have to spend money on marketing, and you're going to have to try to figure out how to target people who have an interest in your product or your company, or people that you have some sort of connection with. For example, I've had a lot of fraternity brothers invest because there was a tie there that people wanted to see a fraternity brother do well. So that's the process. And here's the results that came out of that. It gave us time to slowly build our system, which for a company, building a completely online company is a lot more complicated than I knew it would be complicated, but it's just something I'd not done before. So it's very, there's a lot that goes into building a system that really works well and adding in all the bells and whistles that you want to be on the system. It allowed us to spread risk out to a lot of different investors instead of having a single or handful of investors that are breathing down your neck all the time, which I can tell you, I've had that experience with a VC firm that just makes life miserable for you, and it's not a lot of fun. It gave us time to add some customers. So we were able to gradually bring beta users onto the system and test a lot of our system slowly without any pressure from investors. And then the same process ended up landing us a $5 million invest. Well, actually, they're starting with $2 million and they're going to invest up to $10 million, but they've committed already to $5 million. The same process, the emails that go out monthly brought that investor in. So it really works, and it was exciting to me to see how well that works. And a lot of what I'm trying to do now with MetroStart is teach other local people how to do this. And a bonus, the investor that's coming on board, and this says bonus for Louisville, but it really, MetroStart's kind of acting regionally now. We're trying to help the whole region start to accelerate how we raise capital. But the bonus is that same investor that's coming on board for Blue 222 has $450 million in funds that they're in the process of setting up, and are going to be looking for funnels to send investors or send companies their way. And they're going to involve MetroStart to help them screen companies and send to them for investment. So the whole thing really worked out well in the Blue 222 example, and I think it can work really well for a lot of other companies. So what's next for Metro Startup Launcher? And you've seen metrostartuplauncher.com and you've seen metrostart.org. So we are a nonprofit, and we started as Metro Startup Launcher. We're gradually switching over to MetroStart just because it's shorter, and the .metrostart.org conveys the nonprofit status a little better. So we're switching over to that. But the main thing I'm doing right now is I'm creating an online course that will teach all of the things that I just talked about, but in a lot more depth. So it just will show you step by step how to do each of the things, all the different things, everything you need to be aware of when you're following this process, and all the details of where to go and how to set things up, including things like how to set up your corporation so you get all of the write-offs for the losses during the first year. That was one thing I learned from this process of, if you set up an LLC, so all the losses pass through to the individuals, and your investors invest through safe agreements, you get to write off all of the losses. So if you had a job the year before and then you quit your job and went to work for your own company, you can get basically all of your taxes back for the year before, and just flow those losses through to yourself and use that to help fund the company. A lot of things like that I'll be teaching in that course. And we're working on a regional safe agreement that will be adjusted to make local angel investors comfortable investing in a startup, in terms of how they'll cash out that investment down the road and things like that. So I'm working with Bill Strench and some other local attorneys to try to make sure we create an agreement that everybody likes. And it'll be something that you can just download from the MetroStart website for free and get started on your company, and then maybe adjust the safe agreement a little bit and have an attorney look at it before you start selling investments in your company. And the investor database, this is a big part of what MetroStart is attempting to accomplish, would be just keep building that MailChimp database so it gets bigger and bigger with people who are interested in investing in startups, and educate those investors as to why they would want to invest in a startup. And here's the exciting thing for investors. If you look at the statistics for angel investing, an angel investor who invests in one startup per year is probably going to lose all their money. And that's what you hear most people say if you ask them, hey, you want to invest in my company? And they'll say, you hear people say, well, no, I invested $25,000 in a startup one time and I lost it all. Well, statistically, you did it wrong. statistically, you should have taken that 25,000 and split it up into 12 different companies. Because if you invest in 12 companies, the average angel investor across the United States who invests in 12 companies in a 5-year period has a 27% annual rate of return, which is 3 times the S&P 500 returns, annual returns. So it's a great investment as long as you split it up into multiple companies. So what we're trying to do through MetroStart would be to set it up so that we have people who screen companies, and that's where Shelterweed comes in. And there are multiple other organizations I'm talking to that will be the screeners and mentors for the startup companies that will help guide them through the process of setting up their SAFE agreement and preparing to go out and sell their SAFE agreements to the public, and then helping them through the process. And then maybe the screeners and mentors get a little bit of equity in the company, or charge some for their services or whatever it may be. But they are providing the companies to MetroStart that are prepared to raise capital. Then we have a huge investor database that we've educated on how to invest in startups by spreading their risk out to multiple startups. And maybe they can invest in 10 startups a year and put $1,000 in each startup, which really spreads out their risk, really makes it, the loss on one startup is minimal. If they have enough money, maybe they can do that with $100,000. They put $10,000 in 10 different startups. So by doing this, we can get a lot more startups past that stage of needing the really early stage money. So this is kind of what the ecosystem hopefully eventually will look like. We'll have, Bluetooth 20 or MetroStart will continue doing blogs and videos and podcasts that drive people into our angel investor database on MailChimp. And we just keep getting that bigger and bigger. And every time a company raises capital, we increase the size of that angel investor list. And so it gets better and better for everybody. And if we get enterprise angels and bluegrass angels and all the different angel investment groups in town working from the same database and listing companies on MetroStart when they're prepared to raise capital, we just keep increasing that database of investors and making it easier for everybody. And it allows that company, let's say that you need $50,000 to get your company started, and all you've got is an idea right now. But it's a good idea, and you're a person that one of those mentor groups, those screening groups, thinks is a good bet. Right now, it's really super hard to go out and raise $50,000 from investors who are going to invest at that early idea stage. But if 50 different people could put $1,000 into it, and enterprise angels and bluegrass angels could invest in a lot more startups, but put small amounts in a lot more startups, and then feed that funnel of startups into the community. And then all of those mentors and screeners are continuing to work on tying into larger sources of capital, like the $450 million guys that I'm working with. Then when a company is ready for larger funding, then the $1 million comes in from a larger fund, and all of the SAFE agreement holders get to switch over to shares under the same terms and conditions as the larger investor, and the company is funded and rolling along and growing. So it gets a lot more startups started, and it's easy. It's really a pretty easy process. The Reg D 506C and the SAFE agreement, it's just a pretty simple process. And there's just no reason why. I think if we embrace this, our region can accelerate startups faster than other regions of the country that don't embrace this quickly. Eventually, this is what I'm hoping we'll have the website. The website's already up and running, obviously, but we will eventually have a how to raise capital tab that just takes you right into the online course. And if you want to submit your startup, you do that, and it goes into a funnel that will disseminate your startup to one of the screening organizations. And then we'll have a place where investors can jump on and see all the companies that are available at the moment to raise capital. And we'll be sending out emails to all of those investors when a company is ready to raise. And hopefully, if we get hundreds of thousands of people eventually on that database, it'll be real quick for a company that needs to raise 25,000 or 50,000. We send out one email and we get 25 or 50 people that put $1,000 into a startup. Maybe we can raise that money in a day or two. And then if a company needs to raise $1 million, same process. We go out to a huge database and get people to invest $1,000 to $5,000 per startup. But it's a big pool, and we get a lot of people to invest. That's the hope and where we want to go eventually. So if you can get on the email list, go to metrostart.org and just make sure you join our email list. It should be obvious how to do that. Tell other people what we're doing and to jump on metrostart.org and sign up for our email list. When I put out content, if I'm putting out podcasts, or in fact, if you want to be interviewed, if you have a company or group that wants to be promoted, I'd love to interview you for the podcast. And when I share content, put the content out or share it on your Facebook or Twitter or whatever. And if you really want to help our startup, help with this process, you can click that button up at the upper right-hand corner that says donate. We're a 501c3, so it'd be a tax-deductible donation. And that money would go directly to running Facebook ads and LinkedIn ads or whatever we need to keep building the audience of angel investors and keep educating startups on how to use this process.
Wow. That's great, Alan. Thank you so much. We've got some questions here that have come in, and we've got about 8 more minutes. So
Okay.
let's go through. So the first question was if just clarifying what the SAFE, simple agreement for future equity. Is that
Right.
is that the right acronym? Simple agreement
right.
for future equity.
Yes.
Okay. There was another question here about can the startup company be domiciled in New Mexico? So like if they're trying to raise money there in New Mexico, are you being prevented from doing that because you're out of state?
No, I don't think so. I think as long as we get this up and rolling, as long as your startup, anybody can take the course once I get it up on the site and use it wherever they are. It's the same process will work anywhere. Now there are certain laws in each state that you need to take a look at. I'll mention that there are Reg D laws in each state.
Okay.
So some states might require that you file something with the state before you start raising capital. You need to look into it. But yeah, it'll work anywhere. And as we start to screen companies through the different organizations like Sheltowee and angel investor groups in town, I think as long as it's a company that they like, we can list it and get investors. But it'd be nice. The hope is to increase startups in our region. Is kind of our big goal.
That's great. Another question here, Alan, is which crowdfunding platform allows for unaccredited investors? Do you know which one?
Most of most of those 40-something FINRA regulated crowdfunding platforms allow non-accredited investors. So my favorites are WeFunder. WeFunder.com is really easy to use, and they've had the most success in raising capital. And then Start Engine, I think, is maybe even a little better. I think their fees are lower. They haven't raised as much capital, but I think they're more hands-on. And then there's a company called Seed Invest. They're probably more successful per company, but they're also very strict in who they only allow like 1% of companies that apply to raise capital.
And I think there's a clarification in the Regulation D. Which one of the structures allows for unaccredited investors?
The Reg D 506B.
B. The old way of doing it. The way you started. Right?
And private. You cannot advertise.
Okay. Let me ask you this. I was curious about your strategy, how you bridged from the 506B and then bridged to the C. Mm-hmm. What were the cues, or what was happening in your business? What told you it was time to switch gears to the Regulation C?
I think it was just, I started to realize that most of the people that were investing were accredited anyway. So it didn't make sense for us to limit ourselves to only people that we knew, directly, that we knew. So, in fact, anybody on this call wants to invest in Blue 222, you can let me know. We're still taking investors until the 2 million comes in.
There you go.
But yeah, we just realized that we could open up our potential. We didn't want to continue increasing the database of potential investors on that MailChimp list and begin to get into gray areas where somebody could say, hey, I don't think you know that person very well, but just invested.
Yeah. Well, another thing I was curious was your what's required to manage the communications and keep that. Is that an outsource? Is that kind of someone you want to have part-time, full-time? What does it take to make that work?
For which part?
The kind of the MailChimp, just kind of staying connected with your investors, keeping the communications channel going. What does it take to make that work? Do you outsource that if you were starting out, especially if you're focused on producing your product or getting your company up and running? Is that something that's smart to outsource, or do you need to connect, hire someone inside to work for you in communications?
Well, I did most of that myself, and what I would recommend is MailChimp is super easy to use. You should be able to figure that out. Just to do a monthly email.
Okay.
And it's got nice sign-up forms that you can use on your website. If you need to go just super easy, you can use Wix. Wix.com, Wix, or Squarespace.com to set up a nice looking website. And I think they probably allow you to have a password protected area too.
Okay.
Or you can use WordPress. And I would set up a password protected area where you can put your business plan online, so you don't have to send a hard copy out to anybody. Any of those things that you can't do, that you can't figure out how to do, then find somebody locally that can do those things. If you can find a reasonably priced person to help you figure out those things. But probably the most nuanced thing that having marketing experience definitely would help when you're doing Facebook ads and LinkedIn ads, because there are some, it's not hard to do, but I think it's hard to do well. So finding a good marketing person that knows how to reach the right audience and knows how to run multiple ads and test and see which one's working well, to really hone in on what audience you're advertising to raise capital. That would be nice to find somebody to do that.
Well, wonderful. Alan, thank you so much for your time. We are 2 minutes to go here. And for those of you who stuck around, I want to reward you. You can get a free ebook if you want to download. Alan's written a book I think is pretty cool, little ebook, Little Angels, Big Profits, where he talks a lot about some of these statistics about, diversifying and getting that 27% return, by diversifying in different startups. So if you go to the metrostart.org/free book, so that's listed and it's in your chat feature. Also, I'm offering a free consult. If you want to just go to my scheduler, I'll do a 45-minute call with you just to explore how to apply some of what you've learned today from this webinar, how to connect with Shelterweed Business Network. And speaking of, if you want to shoot me an email and I'm going to let you know a little bit more about the Shelterweed Business Network, you can just email me. Or if you just want to schedule some one-on-one time for free, we could do that as well. So thank you for everyone for being a part of today's call. And I hope you have a wonderful afternoon. Thank you, Maria. Thank you, Alan. Y'all have a great day.
All right. Thanks.